The economics of owning an apartment complex. From the street, an apartment complex can look like one of the simplest businesses anyone could own. 100 doors, 100 kitchens, 100 tenants sending rent every month. The building already exists. The customers live inside the product. And unlike a restaurant, a hotel, or a retail store, the owner does not need to convince everyone to return tomorrow. Most residents sign leases and stay for months or years. It can look like a machine that converts apartments into predictable income. But that picture leaves out the part that determines whether the owner becomes wealthy or quietly runs out of cash. Every door is also a separate responsibility. A water leak in one unit can damage 3 floors. One broken boiler can affect an entire building. A vacant apartment can stop producing revenue while still generating taxes, insurance, utilities, and debt payments. A tenant may move out overnight, but the roof, elevator, parking lot, and mortgage remain exactly where they were. And the money arriving as rent does not belong entirely to the owner. The property manager gets paid. The maintenance team gets paid. The city collects property taxes. The insurance company collects premiums. The lender receives principal and interest. Contractors replace appliances, paint walls, repair plumbing, and prepare empty units for the next resident. By the time everyone else is paid, the owner may discover that a building collecting more than $1 million in annual rent produces surprisingly little spendable cash. So how does an apartment complex actually make money? Why can a fully occupied building still struggle? Why do investors sometimes pay tens of millions of dollars for properties that initially produce only a thin return? And how can a small change in rent, expenses, or interest rates create or destroy millions of dollars in value? To answer that, we first need to understand what an apartment owner is actually buying. An apartment complex is not simply a large collection of homes. It is an operating business attached to a piece of real estate. The real estate includes the land, foundations, walls, roofs, parking areas, plumbing, electrical systems, heating and cooling equipment, elevators, landscaping, and common spaces. The operating business includes leases, residents, employees, vendors, rent collection, maintenance requests, advertising, legal obligations, accounting, and customer service. A beautiful building with weak operations can lose money. An ordinary building with disciplined management can perform extremely well. And 2 properties that look almost identical from the road may behave completely differently on a financial statement. The first major difference is the type of apartment property. A small walk-up building may have no elevator, no pool, and only a few employees. Its rents may be lower, but its operating structure can be relatively simple. A garden-style apartment complex may spread hundreds of units across several low-rise buildings. It needs roads, parking lots, landscaping, drainage, roofs, exterior lighting, and long runs of underground utilities. A mid-rise or high-rise building places more residents on less land, but introduces elevators, fire systems, structured parking, security equipment, and expensive mechanical systems. A luxury property may charge higher rents, but residents also expect better finishes, fast maintenance, clean amenities, package rooms, gyms, pools, lounges, and professional service. Student housing depends heavily on the academic calendar and may turn over a large share of its units at the same time every year. Senior housing can require additional services and specialized operations. Affordable housing may receive public support or tax benefits, but it can also operate under rent limits, income restrictions, and long-term regulatory agreements. These are not interchangeable businesses. A low-cost building cannot support the same service level as a luxury tower. A student property cannot be managed exactly like a suburban family complex. A regulated affordable property cannot always raise rents simply because the market becomes more expensive. The first mistake in apartment ownership is assuming that every occupied unit produces the same kind of income. It does not. The second mistake is looking at the advertised rent and treating it as profit. Suppose a 100-unit apartment complex charges an average of $1,500 per month. On paper, the math looks excellent. 100 units multiplied by $1,500 creates $150,000 of potential rent every month, or $1.8 million per year. But that number assumes every unit is occupied, every tenant pays in full, no lease includes a discount, and no apartment spends time being repaired between residents. Real buildings do not operate that way. Some units are vacant, some residents pay late, some balances are never collected. New tenants may receive a free month or another concession. Existing residents may still be paying older rents below the current asking price. Employees may occupy units at a discount. Damaged apartments may remain offline during repairs. The difference between maximum possible rent and rent actually collected is where the economics begin. Owners often describe physical occupancy and economic occupancy as if they are the same thing. They are not. A building can be 95% physically occupied while collecting far less than 95% of its theoretical rent. If several residents are delinquent, if concessions are generous, or if older leases remain below market, the apartments may be full while the revenue is weak. That is why a serious buyer does not simply count cars in the parking lot. The buyer studies the rent roll. The rent roll shows each unit, the current resident, the lease dates, the rent being charged, deposits, balances, and sometimes concessions or other details. The buyer also studies the property's recent operating statements. How much rent was billed? How much was collected? How many residents moved out? How much was spent preparing units for new tenants? Which expenses are recurring and which were delayed to make the property appear more profitable? A seller may present a beautiful income projection based on future rents. The buyer has to determine what the building earns today. This is where apartment acquisition becomes less like buying a house and more like buying a company. The visible building is only part of the deal. The leases, expenses, employees, vendor contracts, unpaid bills, security deposits, legal disputes, maintenance history, and future capital needs can matter just as much as the walls. Consider the roof. A roof may look acceptable during a sunny inspection and still be only a few years away from replacement. Consider the plumbing. An older property may contain pipes that work today but fail more frequently every year. Consider the parking lot. Small cracks can become a large resurfacing project. Consider heating and cooling equipment. A building may contain dozens or hundreds of separate systems, each approaching failure on a different schedule. Then there are elevators, fire alarms, electrical panels, balconies, windows, siding, drainage, retaining walls, sewer lines, pools, gates, and common area interiors. An owner who buys only the current income may accidentally inherit the previous owner's postponed expenses. This is called deferred maintenance. It is one of the easiest ways for an apartment deal to look profitable before purchase and become painful afterward. The property may produce cash during the first year because the former owner delayed replacing equipment. Then several systems begin failing at once. The new owner is not losing money because apartment ownership suddenly stopped working. The owner is paying bills that were quietly accumulating for years. Once the building is operating, revenue usually comes from more than base rent. Parking spaces may be rented separately. Residents may pay for storage lockers, laundry, reserved parking, pet-related charges, furnished units, or premium locations within the property. Some buildings recover a portion of water, trash, or other utility costs from residents where local rules and lease terms allow it. A well-run property understands each revenue source, but additional fees cannot rescue a fundamentally weak building. The largest income source is still rent, and rent depends on three things: how many units exist, how many are occupied and paying, and how much the market will support for each unit. The owner controls the first number only by constructing more apartments or changing the property. The second number depends heavily on management. The third depends on location, competition, local incomes, housing supply, property quality, and the broader economy. This creates a limit that inexperienced owners sometimes ignore. Renovating an apartment does not guarantee that residents can or will pay a much higher rent. A new countertop may improve the unit, but the surrounding neighborhood still determines much of its value. The market does not reimburse every dollar spent. An owner might invest $20,000 renovating a unit and discover that the improvement supports only a modest rent increase. If the additional annual income is too small, the renovation may take many years to recover its cost. The same problem appears with amenities. A pool, gym, dog park, clubhouse, or package room can attract residents and support rents. But each amenity also creates construction costs, maintenance expenses, insurance exposure, utilities, cleaning, and eventual replacement. The question is not whether residents like the amenity. The question is whether the property earns enough additional income or reduces enough vacancy to justify owning it. Now consider the expense side. Apartment operating expenses usually include property taxes, insurance, payroll, management fees, repairs, maintenance supplies, utilities paid by the owner, trash removal, landscaping, pest control, cleaning, security, legal work, accounting, advertising, software, and administrative costs. Some expenses rise slowly, others can change suddenly. A reassessment can increase property taxes. An insurance renewal can become far more expensive after storms, fires, or changes in the local market. Utility prices can move, labor costs can rise, a series of plumbing failures can destroy the maintenance budget, and not every large cost appears as a normal operating expense. Replacing a roof, elevator, boiler, parking lot, or major plumbing system is usually treated as a capital project. That distinction matters because the property's everyday profit may look healthy while its long-term cash needs are not. Imagine a building producing $400,000 in annual cash flow before major replacements. That sounds strong. But if the property needs a $1.2 million roof and exterior project every 15 years, part of that annual cash flow should really be reserved for the future. An owner who spends every dollar during the good years may face a crisis when the capital project arrives. This is why experienced operators maintain reserves. A reserve is not idle money. It is money already assigned to problems that have not happened yet. Every roof is moving toward replacement. Every appliance is moving toward failure. Every parking lot is moving toward resurfacing. The date is uncertain. The cost is not. After revenue and ordinary operating expenses are calculated, the building produces a number called net operating income, or NOI. NOI is one of the most important numbers in apartment investing. It is generally the property's income after vacancy and operating expenses, but before mortgage payments, major capital projects, income taxes, and certain owner-specific costs. This means NOI is not the owner's final profit. It is the income produced by the property before considering how the buyer financed it. Two owners can operate the same building and produce the same NOI, but keep very different amounts of cash. One may have purchased the property with little debt. The other may have borrowed aggressively and send most of the NOI to the lender. Return to the hypothetical 100-unit complex. Its maximum annual rent was $1.8 million. After vacancy, concessions, and uncollected balances, suppose the building collects about $1.67 million in rent. Add $90,000 from parking, laundry, storage, and other legitimate property income, and total collected revenue becomes roughly $1.76 million. Now suppose normal operating expenses consume $780,000. The property produces approximately $980,000 of NOI. That sounds like nearly $1 million of profit, but the mortgage has not been paid. If the buyer paid roughly $17.8 million for the property and financed about $11.6 million of the purchase, An illustrative loan could require more than $830,000 in annual debt payments, depending on the interest rate and loan terms. The building that appeared to generate almost $1 million of NOI may leave less than $150,000 before income taxes, major capital projects, and unexpected costs. That is a thin cushion on an asset worth nearly $18 million. One bad year can erase it. This is why lenders and investors focus on debt service coverage. They want to know how comfortably the property's income can cover the required loan payments. If NOI barely exceeds the mortgage payment, the owner has little room for vacancy, rising expenses, or repairs. A property can be profitable on paper and still be financially fragile. Debt creates leverage. Leverage allows an investor to control a large property with less personal capital. If the building's value rises, the return on the investor's original equity can become much larger. But leverage also magnifies mistakes. The lender must be paid whether apartments are full or empty. The lender does not reduce the mortgage because insurance doubled or a boiler failed. The lender does not wait because the owner offered concessions during a slow leasing season. Debt is fixed, while apartment income is uncertain. And many apartment loans do not remain unchanged forever. Some mature after a set number of years, even when the payment schedule assumes a longer period. The owner may need to refinance or sell the property when the loan matures. If interest rates are higher at that moment, the same building income may support a smaller loan. An owner can operate successfully for years and still face a refinancing problem. Suppose the old loan balance is $12 million, but new lenders will provide only $10 million under current rates and underwriting. The owner must contribute the difference, find another source of capital, negotiate with the lender, or sell. This is one reason apartment ownership can feel stable until it suddenly does not. The residents are still paying rent, the property is still occupied, but the financing environment has changed underneath it. Apartment values are also unusually sensitive to NOI and market return expectations. A common way to describe this relationship is the capitalization rate, or cap rate. In simplified form, the cap rate is the property's annual NOI divided by its price. If investors are willing to buy a property at a 5.5% cap rate, a building producing $980,000 of NOI may be valued around $17.8 million. This creates a powerful feature of apartment ownership. A permanent increase in NOI can create much more value than the annual income alone. Suppose better management increases annual NOI by $100,000. At the same 5.5% cap rate, that additional income could support roughly $1.8 million of additional property value. The owner did not need to add hundreds of new apartments. The owner improved the income produced by the existing property. This is why investors obsess over occupancy, rents, utility recovery, payroll, contracts, and maintenance efficiency. Small operating changes can have large effects on valuation. But the formula works in reverse. If expenses rise by $100,000 and rents cannot increase, the same valuation method can remove roughly $1.8 million of value. And even if NOI remains unchanged, the building can lose value when market cap rates rise. At a 5.5% cap rate, $980,000 of NOI suggests a value near $17.8 million. At a 6.5% cap rate, the same NOI suggests a value closer to $15.1 million. Nothing inside the apartments needed to change. The market simply demanded a higher return. This is the paradox of apartment investing. The building feels physical and permanent. Its price can change dramatically because of financial assumptions that residents never see. The most common strategy for creating value is often called value-add investing. An investor buys a property believed to be underperforming, improves the apartments or operations, raises income, and eventually refinances or sells at a higher value. The plan may include renovating unit interiors, improving landscaping, repairing common areas, adding useful amenities, reducing vacancies, collecting rent more consistently, replacing inefficient equipment, or negotiating better vendor contracts. The strategy can work, But the phrase value add makes the process sound easier than it is. Renovations require cash before they produce income. Units may need to remain empty during construction. Materials and labor can cost more than expected. Existing residents may not want premium finishes or higher rents. Local laws may limit how and when rents can change. Aggressive increases can damage reputation, increase turnover, and create political or legal problems. A spreadsheet may assume every renovated unit immediately rents at the highest advertised price. Reality may deliver delays, discounts, and additional repairs. The owner is also operating someone's home. That changes the business. A broken machine in a factory can reduce production. A broken heater in an apartment can leave a family without heat. A roof leak can damage personal belongings. A security failure can affect safety. A maintenance delay can become a legal issue, a public complaint, or a reason for residents to leave. The best operators do not treat maintenance only as a cost to minimize. Maintenance protects the residents, the property, and the future income. Fast repairs reduce damage. Clean common areas support retention. Preventive inspections can catch small problems before they become emergencies. Poor maintenance may improve 1 month's financial statement while destroying the next several years. Apartment ownership is therefore a people business. Someone must answer calls, process applications, explain leases, collect rent, coordinate repairs, inspect units, manage vendors, handle emergencies, and communicate with residents. A small building may be managed directly by the owner. A large complex may require a property manager, leasing staff, maintenance technicians, groundskeepers, cleaners, and regional supervision. Scale creates advantages. A 200-unit property can spread the cost of management, software, tools, and maintenance staff across many apartments. A 10-unit building may suffer when one vacancy removes 10% of its rental income. At a 200-unit property, one vacancy removes only half of 1%. But scale also creates complexity. More units mean more work orders, more leases, more systems, more employees, and more opportunities for small errors to become large expenses. Then there are the rules. Housing is heavily regulated because it is essential to daily life. Federal fair housing law prohibits discrimination in housing based on protected characteristics, and state or local rules may add further protections and requirements. Owners need consistent advertising, screening, leasing, accommodation, and enforcement practices. Building codes, safety rules, accessibility requirements, deposit laws, eviction procedures, notice periods, inspection standards, rent regulations, and licensing can vary by location. A profitable operating idea in one city may be illegal in another. Ignoring these obligations is not a shortcut to higher returns. It is a path toward lawsuits, penalties, damaged reputation, and unstable operations. Apartment ownership also receives tax treatment that can make the investment appear more attractive. In the United States, residential rental buildings are generally depreciated over 27.5 years for federal tax purposes, while land itself is not depreciated. Depreciation can reduce taxable income even when the property is producing cash. But depreciation is not free money. The rules are complex. Individual outcomes vary, and part of the benefit may be addressed when the property is sold through depreciation, recapture, and other tax consequences. The tax result should support a good investment. It should not be used to rescue a bad one. What about building a new apartment complex instead of buying an existing one? New construction removes some inherited maintenance problems, but introduces an entirely different collection of risks. The developer must acquire land, obtain zoning, design the project, secure permits, arrange utilities, finance construction, manage contractors, and survive delays before collecting the first rent payment. The land produces no rental income while approvals are pending. The construction loan accumulates interest while the building is being created. Materials can become more expensive. Contractors can fall behind. Weather can delay work. Neighbors can oppose the project. Utility connections can require unexpected upgrades, and when construction ends, the building may still be mostly empty. The lease-up period begins. The owner must advertise the property, hire staff, offer tours, sign residents, and gradually fill the apartments. Operating expenses begin before the property reaches stable occupancy. A new building can be beautiful and financially dangerous at the same time. If the market delivers fewer renters or lower rents than expected, the developer cannot easily remove floors from the finished building. Apartment supply arrives in large pieces. Demand arrives one household at a time. This is why timing matters. A developer may begin a project during a housing shortage and open several years later alongside thousands of competing new units. The original market study may have been correct when construction began and wrong when leasing started. Buying an existing property avoids construction and lease-up risk, but the buyer pays for income that already exists and may inherit aging systems. Building new provides modern units and potential long-term efficiency, but requires years of capital and execution before stabilization. Neither path is automatically safer. The risk simply appears in different places. So where does the owner's long-term wealth come from? There are several possible sources. The first is current cash flow after operating expenses, debt payments, and reserves. The second is loan amortization. Each principal payment can increase the owner's equity, even when the building's market value does not change. The third is income growth. If rents and other income rise faster than expenses, NOI can increase. The fourth is appreciation. The land and building may become more valuable because of population growth, job creation, limited housing supply, neighborhood improvement, or investor demand. The fifth is operational improvement. Better management can reduce vacancy, control expenses, improve resident retention, and increase the property's value. The sixth may be tax efficiency, depending on the owner's situation and the law. But none of these sources is guaranteed. Cash flow can disappear into repairs. Amortization can be overwhelmed by falling property values. Rents can stagnate while expenses rise. Neighborhoods can weaken. New competitors can open. Regulations can change. Insurance can become difficult to obtain. Refinancing can arrive at the wrong moment. The apartment business looks predictable because people always need housing. That does not mean every building is a good investment at every price. Demand for housing and profit for a particular owner are not the same thing. A building can remain socially necessary while being financially overleveraged. This leads to the most important question in the entire business. What price can the property support? A great apartment complex purchased at an unrealistic price can become a bad investment. A difficult property purchased with enough margin for repairs and risk can become a strong one. The purchase price determines the debt, required equity, expected return, and room for mistakes. During competitive markets, buyers may assume rents will keep rising, vacancies will remain low, expenses will behave, and refinancing will always be available. Those assumptions allow them to justify higher prices. But the building does not know what the buyer paid. The roof costs the same to replace. The maintenance team expects the same wages. Residents compare rents with the same competing properties. Only the owner's financial pressure changes. The successful apartment owner therefore studies the downside before celebrating the upside. What happens if rents are 5% lower than expected? What happens if insurance rises sharply? What happens if occupancy falls during renovations? What happens if the property needs a major plumbing project? What happens when the loan matures? How much cash remains after the lender is paid? And how long can the property survive before the owner must contribute more money? This is called stress testing. It is not pessimism. It is recognition that apartment buildings are long-lived assets operating in uncertain markets. The owner cannot predict every failure. The owner can decide whether the deal has enough room to survive one. So can owning an apartment complex make someone wealthy? Yes, but rarely because hundreds of rent checks simply arrive and remain untouched. Wealth is created by buying at a sensible price, financing carefully, maintaining the property, treating residents consistently, controlling expenses, protecting reserves, and improving income without assuming the market will solve every mistake. The unsuccessful owner looks at 100 occupied apartments and sees 100 rent payments. The successful owner sees leases, turnover, payroll, taxes, insurance, capital projects, debt maturities, legal duties, and a building that must remain useful for decades. From the parking lot, the property may still look like a simple collection of doors. But behind those doors is a machine made of people, concrete, plumbing, contracts, financing, and time. Rent brings money into the building. Managing everything that happens after the rent arrives is what determines whether the owner actually keeps any of it.